Hi, I'm Kristof Gleich, the President and the CIO here at Harbour Capital Advisors. Welcome to another episode of Views from the Harbour, which is our take on everything that you need to know on what's happening around the world and in markets. This week's episode of Views from the Harbour is a replay of a webinar that I hosted with my colleague Jake Schurmeier. And the subject of the webinar is the debt ceiling and what happens when the US Treasury runs out of money. Nobody knows when this exactly could happen because there's a lot of variables like tax receipts and expenditures and things that you can kind of put off and reprioritize. So Janet Yellen has suggested that June 1st might be the X date, which means the date that they kind of officially run out of money. Really complicated, really important topic, unprecedented. Because if you think about it, one of the US's privileged positions in the world is they are the issuer of the world's reserve currency, the US dollar. And in theory, the amount of dollars you can issue, the debt you can issue, should really kind of be unlimited in a way. But they can't keep issuing new debt because there is something called the debt ceiling. And in order to get the debt ceiling either increased or suspended, it has to go through Congress. And obviously the political situation at the moment makes that very complicated. Now, Jake is the ideal guest because Jake used to work at the Treasury, and for regular viewers, you'll know that. But not only that, Jake actually worked on the group at the Treasury who was charged with setting up the contingency plans for what the Treasury would do if the US ultimately defaulted on its debt and couldn't issue any more debt. And so he's got the ultimate kind of insider's view. So it's a fascinating conversation where we talk through why this matters, what the contingency plans are, and ultimately what we think is going to happen. So I hope you enjoy this very special episode, my conversation with Jake Schurmeier. Oh, there's one more thing. We want to make sure that we're addressing the questions that are most important to you. So as a new feature, you'll see an email address come up now, which is views@harbourcapital.com. If you have any questions, topics, sub-themes that you want us to go into, do a deep dive on, please send us your questions, send us your ideas, and we'll be sure to get to them as frequently and as often and as timely as possible in our next episode of Views from the Harbour.
Good afternoon and welcome to today's Harbour Capital webinar, Untwisting the Pretzel, What Happens When the Treasury Runs Out of Money. My name is Kristof Gleich. I'm the President and the CIO here at Harbour Capital Advisors, and I will be your moderator today. We welcome questions, as many as we can possibly get. We've already had a ton come in. To submit additional questions, type your question into the Ask Question widget on the left-hand side of your screen, and please do not forget to hit the Submit button. Now, let me introduce today's speaker. So we're joined by Jake Schurmeier, Portfolio Manager here in the Multi-Asset Solutions Group at Harbour Capital Advisors. Jake is in charge of our fixed income investing. And given his background, he came to me a few weeks ago and he volunteered today's webinar as a topic that he feels particularly well qualified to discuss. You'll see why in just a short second. So Jake not only spent 7 years at the Federal Reserve Bank of New York, but in 2018, he was sent on a secondment to the Office of Debt Management, the office responsible for Treasury issuance, where he worked pretty incredibly on the team that was part of the contingency planning of what the Treasury would ultimately do should the debt ceiling be breached. So Jake's got that unique perspective. You can see it from the Fed perspective. He can see it from the Treasury perspective. So uniquely qualified, I certainly think so. So Jake, welcome.
Happy to be here.
So I'm going to moderate, but I'm going to pass over to Jake shortly. But just let me cover sort of briefly what we want to cover today. So firstly and foremost, your questions. We've had a record number of questions come in ahead of time for this webinar, which I think really speaks to how important this issue is and how sort of top of mind share it is right now. And those questions broadly fall into kind of four themes or four areas that we'll try and cover. Number one is this questions around the default mechanics and how this works in practice and order of payments and things like that. So we'll definitely spend some time on that and the mechanics of what happens if there's actually a default. Number two, there were questions around the investment implications of what's happening, and we'll certainly cover those as well. Thirdly, there were questions around the longer term implications as it relates to the threats to the dollar hegemony or dominance and the dollar-based system, which is pretty topical at the moment. So we'll try and cover that a little bit as well. And there was also, I think, another bucket of some interesting political questions, should we say, where people have been asking around various incentives and who stands to win and lose, etc. And we'll try and touch upon some of those as well. So I'm going to pass over to Jake in just a second. We're going to cover, let me just get the slides here. We're going to cover what the X date is. We've heard a lot about this in the press. What are some of the variables that determine when we might hit this X date? Remember, Janet Yellen announced in January that the Treasury was essentially enacting extraordinary measures. So we've been in that phase for a few months now to push that X date out as far as possible. But some of the estimates have been as soon as June 1st, but there's a fair degree of ambiguity around that. Jake will walk us through that. We're going to talk about what happens if there's no deal and what are some of the alternative paths. And yes, we will be talking about the potential minting of a 1 trillion platinum coin by the Treasury, or indeed invoking the 14th Amendment. And I know President Biden fielded questions around those two things specifically yesterday. So we'll give you our view there. And we're going to talk about various paths to resolution and ultimately what we think the end game is going to be. So with that, Jake, please take it away.
Great. Yeah, so the current crisis really started in January when we have the beginning of a debt ceiling suspension period. And so that's when Treasury has to invoke these extraordinary measures, in other words, accounting tricks, to keep it so that they do not go over the debt limit, which is a statutory limit on the total outstanding debt for the federal government, including both marketable and non-marketable issuance. So on that date, they get access to these extraordinary measures. It's somewhere on the order of 200 billion, upwards of 400 billion. It depends on the time of year when the debt ceiling suspension period begins. And then they have their cash balance on hand. And the uncertain part is what happens in between. So how much of inflows do they receive? How many outflows? How is congressional spending changing? What are tax receipts? All those sorts of things. And so, just last week, Janet Yellen provided a more updated forecast and said, the June 1st date seems like a highly probable date at which Treasury may run the risk of running out of money. And so it's always going to be uncertain. There's a lot of forecast errors around the daily inflows and outflows. At Treasury, they actually forecast, on a weekly, monthly, quarterly basis, actual daily inflows from all these different programs. But there's a lot of uncertainty. Treasury makes upwards of 80 million payments per day. So that's separate payments, not just the nominal amounts that are far larger. And so once Janet Yellen came out with that June 1st date, you saw near maturity bills really sell off. And that's that chart in the upper left-hand side. Recently, we had an auction of the 4-week bill earlier last week. So on Thursday of last week, and that matures right past the June 1st date. And so we saw a very large sell-off and a kind of an auction tail. So it was very poorly received by the market as people try to actively avoid bills maturing right around this X date. And so the Treasury Secretary always has an incentive to make things seem more dire. Because again, they don't want to run into a situation where they're running out of money, where they're thinking through these far more politically difficult questions. But right after Janet Yellen came out, the director of the Congressional Budget Office came out and affirmed that that June 1st date was, well within the bounds of reason. It wasn't kind of improbable. It wasn't kind of a very optimistic forecast from the Treasury Secretary. So markets have really centered around that. And you're starting to see movement on the negotiating side. House Leader McCarthy was at the White House yesterday, along with Senate Majority Leader Schurmeier, Senate Minority Leader McConnell. So negotiations are really beginning in earnest, and they're expected to meet again on Friday. And that's because if you look in the chart in the upper right-hand side, Treasury's cash is starting to dwindle. We have a daily measure of that cash balance. And so you can see that large uptick at the very end of the chart. And that was the effects of tax day. But if you look in the chart in the bottom left-hand side, one of the reasons why this June 1st date was pulled forward from where people were expecting maybe late July, early August, as recently as a month ago, is that the 2022 tax season came in well below expectations relative to the prior year. And the reason for that, we think, is largely because of capital gains. And so there were a lot of realized capital gains in 2022 from the 2021 tax year. We've seen far less than that, obviously, because both equity markets, crypto markets, rates markets, anywhere you look, there weren't a lot of positive financial returns to be gaining, to seeing capital gains. And so we've seen much lower tax receipts. And so that pulls forward that likely X date. And if you look in the bottom right-hand chart, Treasury's cash flows on any given month are very lumpy. Typically, the largest amount of outflows from the Treasury's cash balance are the first business day of the month. That's when they pay large trust funds like Social Security, Medicare, Medicaid. That's when they pay a lot of veterans benefits. That's when they pay active duty military. That's when they pay out Social Security, Medicaid, all of these sorts of entitlement programs. And so, the June 1st date has this very large net outflow expected. So you combine that with a dwindling cash balance and some forecast errors, and it's very possible that Treasury would run out of money as soon as June 1st. If we get past June 1st, you can see we expect Treasury to run, similar but small deficits over the next 2 weeks. But if they can get to June 15th, which is a large corporate income tax date, so when corporations pay quarterly corporate taxes, you can get to that June 15 date. That gets you to the end of the month. And again, for technical reasons, at the beginning of July, there are a lot more extraordinary measures released to the Treasury. And so that would probably take us into late July. But again, it all assumes that you can get through those first 2 weeks of June unscathed. And we think, the guidance from the Treasury Secretary, the director of the CBO, the fact that negotiations are taking place suggests that everyone believes that June 1st date is a really credible X date.
So credible, maybe a touch conservative, but not overly scaremongering. Now, Jake, tell us about the top left chart with the bills by maturity. You've got this big leap up in yields around kind of X date. Like what's going on? Like what's that risk premium representing? Is that kind of, if I'm sat running a JP Morgan or a BlackRock money market fund, I just don't want to hold there's no yield that's high enough for me to hold paper in and around that X date. So I'm just either holding front dated paper or just going kind of further out on the curve.
Yeah, that's exactly it. It's kind of this passive avoidance rather than kind of an active choice. It's the risk of getting that tap on the shoulder from your risk manager saying, why are you holding these bills when you can hold one a couple days shorter, a couple weeks longer? And yeah, you lose 40, 50 basis points in yield. But for such a low duration, it's really not worth it from an institutional standpoint to take the risk of holding an at-risk bill, because there's operational considerations. If we were to somehow come into a place where Treasury is likely to default, there's going to be a lot of operational headaches associated with holding some of these at-risk bills, at-risk coupon securities. So just from a reputational and kind of your own career risk, it just makes sense to forego those few extra basis points and kind of avoid this date. We don't expect hedge funds, kind of any more active managers, to be taking levered bets, shorting these securities, because there's just not enough duration, and it's a very kind of one-sided risk. So we think it's just people avoiding these bills, like we saw in last week's auction, where you saw a very low bid to cover relative to typical bill auctions, and you saw a large tail in the auction.
Very good. Right, let's keep moving through, and I want to ask everybody a quick poll question. Are you confident the US debt ceiling is going to be resolved? I guess we should say in the kind of short term. So are you confident that the debt ceiling is going to be resolved in the short term, meaning in the next few weeks? So if you are, please click A. If you are not, please click no. And I see I'm just going to give it another 10 seconds. So are you confident the US debt ceiling will be resolved in the short term? A for yes, B for no. We still have a number of answers coming in. I'll give it another few seconds. What do you think, Jake?
Yes.
Okay.
Cautiously optimistic.
Cautiously optimistic. I hope you're right. So let's see if the audience share your cautious optimism. Right. So Jake, what do you think of that? 70% say yes, 30% say no.
Yeah, I mean, the no is much higher than my prior would suggest. So, that I think that points to kind of what we're seeing in the bill curve and some elevated concerns and why we're seeing so much interest in this topic.
I think this is taken from the Bank of America Merrill Lynch Fund Manager Survey, which is the largest survey put out to professional fund managers across the world, and asking them the same question. And I think even more so, professional money managers, investors broadly are not overly worried about this issue in the short run and think ultimately it will be resolved, which is why I think, barring that price action we looked at in the T-bill markets have been relatively sanguine with how they're pricing this in so far, certainly compared to 2011, which is the last time these debt issues really came to the surface and actually resulted in a downgrade for the US government. So Jake, why don't we keep going?
Great. Yeah, so we just kind of wanted to give an overview of where negotiations stand. So, typically these are passed on a bipartisan basis. They're typically called clean resolutions. So there's nothing attached. There's no spending limits. There's no fiscal negotiations around with it. And ultimately it passes on a bipartisan basis. Kind of the exception to that was 2021 when Democrats had unified control of the government. And then, during the first couple of years of the Trump administration, the debt limit wasn't really an issue because it had been suspended beyond the first two legislative cycles. And so typically we'd expect some sort of agreement among members of both parties and probably a clean raise of the limit. But this time is a little different because of the negotiating positions of the two parties, as well as kind of the leverage embedded in a split government. 2011 was kind of the only time we saw a meaningful change in fiscal spending, kind of a meaningful result from the debt limit standoff. And so then both parties agreed to the Budget Control Act, which created these spending caps that unless Congress came to an agreement to change overall spending, there'd be automatic cuts to discretionary spending. And as you can probably expect, the parties didn't come to an agreement, and we saw that fiscal cliff occur where we saw an automatic cut to federal spending in 2013. So that's kind of the only time we've seen some material kind of change in the fiscal trajectory because of one of these periods. So Republican majority in the House came out with a bill raising the debt limit until 2024 recently that had a lot of these discretionary spending caps, some repeals of various Biden programs, and kind of reinstating student debt were the main tenets of it. So this beginning negotiating position really isn't credible for the Democrats at this point. But again, this is a bargaining process. This is both sides trying to build leverage, the Treasury Secretary trying to build leverage. It's a multi-period game from all of these people. And then again, we had the 5/1 date where then we heard that June 1st was kind of a live deadline. And so now we're really starting to see those negotiations begin in earnest. Yesterday we had kind of the first meeting of the major players in Congress and the president. They're expected to meet again on Friday.
And we've touched upon this, but we had a number of questions around the investment implications. So what are you seeing? You touched upon this on the T-bills earlier. Are investors concerned? Are they concerned enough? Some of the questions that we got in, I'll read some of them around this topic. What date do the markets start to price in a real risk that the US could default? Others are advocating for investments in treasuries. How do we think they would perform in this crisis? Is that an area that people should be invested? Any way to keep the S&P repeating the disaster of August 2011, where I think it was down circa 15 odd percent, recommending portfolio changes. So what are you kind of seeing from an investment perspective at the moment?
Yeah, I mean, our recommendation is to look through this. So whatever positioning you have based on the fundamental trajectory of the economy, to retain that. There's going to be volatility. The point of a deadline in some ways is to force people to the table. And, we're going to run up against that deadline because no one wants to blink. Everyone wants to retain their leverage. And so we'd expect this to continue towards June 1st and to be an ongoing source of volatility and headlines. But we don't think this is going to have a material effect on the outlook going forward. So in that world, we're positioned pretty defensively because we think the cumulative effects of Fed rate increases, the banking stress that we've seen, will result in the labor market beginning to weaken and ultimately to weigh on equity returns and the overall economy. We're seeing year over year earnings growth from the S&P dip into negative territory. We think that's going to become more negative in the quarters to come. And we think fixed income offers a very attractive alternative with yields around 5%, investment grades yields well above that, high yield even further. So we think there's just an attractive quality source of income that you can receive, unlike much of the past, post-financial crisis period. And so we're overweight fixed income relative to equity risk.
So you're more focused as an investor on the inflation picture, the interest rate picture, what the potential implications for growth that's going to be. This at the moment is jockeying for position. It's causing some noise. But the way the market sort of seems to be perceiving it at the moment is the old saying is, fool me once, shame on you, fool me twice, shame on me. And given what happened in 2011, the market ultimately thinks that something's going to be kind of figured out. Now, what could that something look like? What are the options? What are the Treasury's options? I want to spend some time here now, Jake, because we got a lot of questions on the default mechanics and how this kind of works in operationally. So can you touch upon, I'm just going to sort of paraphrase some of the questions. Can you touch upon the order of priority of payments should the Treasury hit a debt limit, specifically as it relates to Treasury, money market funds, or repos? Will the impact the default have on money market funds invested in T-bills? T-bonds, so similar question there. Will principal payments on notes coming due be deferred or not paid at all? Seems incredible to even be thinking about that question with this topic at hand. Do you think would you expect the Fed to pay accrued interest in the event of a default, i.e. they default and don't return cash for a number of days? Will they pay additional interest or additional days? You get the idea. There's a lot of questions like in the nitty gritty. What are the choices that Treasury have? What are they going to prioritize?
Yeah, so the baseline assumption is that the Treasury will prioritize payments to debt holders. And so what that means is in the event that they can't issue new debt, automatically deficits go to zero. So that, typical US budget deficit is running around 5% of GDP. So that's an immediate 5% hit to overall government spending as a portion of GDP. And so that means not making payments to Social Security, Medicare, the VA, overseas active duty military, all these sorts of things. And kind of the baseline assumption is that Treasury would prioritize debt holders. So one, we don't have a credit event on our large stock of existing debt. And then two, Treasury isn't making a political kind of hierarchy of who matters more. Treasury is not using their discretion to say we should pay veterans instead of Social Security recipients, instead of Medicare, Medicaid, so on and so forth. There's a large waterfall of payments that go out. And Treasury, I think, has been pretty explicit that they'll pay debt holders knowing that the political consequences of Social Security payments not going out, et cetera, will be just too much to bear. So that in the event of a default, it would be quickly resolved because everyone has a constituent who's receiving Social Security. Everyone has a constituent who's a veteran, so on and so forth. And so it kind of cuts across the political spectrum.
So I want to just make sure. So if you're a creditor of the US government, the best place to be is in debt, right? If you hold Treasury, US government debt, T-bills, you think that's kind of top of the stack, the most senior creditor, and the US government is going to prioritize that. So you could be in a situation where, there's a very real, human side to this, where Social Security payments or payments to veterans get cut before holders of debt. I just want to make sure I understood that correctly.
Yeah, exactly. And that's why, if you're the Treasury Secretary, the political consequences. Even if you're the president, the political consequences of that for Congress members who have the power to raise the debt limit solely in their jurisdiction outside of these kind of different things we'll talk about. The political consequences of that are so grave that they'll eventually raise the debt limit quickly. But in kind of terms of the mechanics, in the event of a default, so this assumes that Treasury eventually just runs out of money to pay interest, to pay back principal, can't come to market to redeem securities and refund themselves. What they do, based on these are from public transcripts from past FOMC meetings, what they do is they'd typically roll over maturing dates for Treasury securities. So if you have a Treasury bill maturing tomorrow and the Treasury is unable to pay that back, what they do is they roll the maturity to the following day. And so if you're that holder as of that record date, you're still going to get paid. You're just going to get paid on a delayed basis. And what we'd expect is Treasury would make up all the principal payments in arrears, make up all the lost interest payments in arrears, and basically make everyone whole with some delay. But there's kind of technical nuances about when Treasury would have to do that. So it's at the very end of the day, and they have to roll those maturities. So similar to the debt limit itself, there's again an incentive for Treasury to wait as long as possible to heap the pressure on politicians to actually make the fundamental change and raise the debt limit. But to the extent of all these questions, we'd expect everyone to get paid back. We would be technically in default on those securities. These securities would still be tradable. You could still post them in repo, but we'd expect a lot of money funds to actively avoid these, as well as holders of these to be selling them into dealers, other investors who could then post them at the Fed. And that kind of goes to these Fed options. The Fed wants to stay out of the politics here. What their focus would be on, how do we ease the financial stability strains that would result from a default? And so it's really focused on providing funding through outright purchases, securities lending, discount window lending, repurchase agreements. A lot of it would be focused on how can the Treasury absorb some of those at-risk securities. And so we think market participants, money funds, whomever, would be putting those at-risk securities, those bills, coupons, et cetera, to the Fed. So the Fed would be that holder of record whenever we got a resolution to the debt ceiling. There's also these.
There's some questions coming through, which you kind of touched upon, but maybe just go over it again. Will investors be compensated with additional return if the maturity is pushed back? Assuming defaults and they have to roll maturities forward, would they pay interest on those missed days? When you were talking, Jake, a minute ago, it sounded eerily similar to what Greece did in the Eurozone crisis. But I think there we were talking about that maturity extensions from like 5 to 50 years, not from like 1 day to 5 days or to a week. But will there be extra compensation, do you think, for missed principal, lost interest, etc.?
Yes, I think so. So Treasury sort of already has this in place in the sense that a lot of Treasury securities, they either mature in the middle or the last calendar day of the month. And those often come on weekends. And so Treasury will actually make the payments and see the cash flows on the next business day. So a security maturing on July 31st might actually mature and the payments go forth on August 2nd, as an example. So in that case, Treasury pays you those extra 2 days of interest. And so there are, I think, systems in place to do this. And I think that would be the expectation, that Treasury would make back whatever interest you're owed based on the price, the original issuance price of the security, to make you whole over those next 2 days, those opportunity costs.
So it sounds like sort of hitting the debt ceiling doesn't automatically equal US debt default. And that, in fact, making interest payments or principal payments will be top of the pile, top of the prioritization list. But if that means they then have to sacrifice veteran payments, healthcare payments, it's quickly going to be rise to the top of everybody's inbox, and it's going to force people to the negotiation table. But even if there is a technical default, missed principal date, the kind of mechanisms that already exist, and you feel confident that any investor in US government debt is going to be made whole, even if their instruments are extended or matured. by a little bit. So what are some of these? Let's touch upon some of the legally suspect executive branch options. We heard President Biden mention these, but what a little bit yesterday when he was asked a question in the press conference. But like, what is minting a 1 trillion coin like mean?
Yeah, so this dates to a law passed in 1995 that basically allowed the Treasury Secretary to mint gold coins and platinum coins, basically for commemorative purposes. So you could have a $10 platinum coin with some historical figure, some national monument, whatever it may be, which you can generate revenue from. It's commemorative. There's it's a collectible, that sort of thing. But the law's pretty vague in terms of the limits on that. Whereas the limits for pennies, typical coinage, or even dollar bills is far more prescribed. But the platinum coin allows the Treasury to do it in any denomination and size. So theoretically, they could mint a $1 trillion coin, a 5 trillion, 10 trillion, any made up amount they'd want in order to do it. And what they do is they'd mint the coin, probably at the West Point Mint. Someone would drive that over to the New York Fed, deposit it, and all of a sudden the Treasury's cash balance would increase by $1 trillion, while the Federal Reserve's balance sheet would also increase on the liability side by 1 trillion in terms of the amount of currency outstanding.
Do you give any credibility to this platinum coin theory? I know this has been covered by the Odd Lots podcast, which I'm a regular listener to. But what kind of probability do you give this?
I think it's a really fun way to describe how inane this whole process is. I think the 14th Amendment is probably a more likely extreme option. And the 14th Amendment, basically, these are a series of amendments passed after the Civil War. And, it's the fourth section of that law that basically it was dealing with debt incurred by the Union during the Civil War, and basically said that public debt issued by the U.S. shall not be questioned. And so I think legal scholars generally agree that that's probably the safest option and the most likely option. Of course, this would precipitate a constitutional crisis. It would be challenged. But again, by the time it would reach the Supreme Court and be resolved, we'd be past the underlying issue.
And presumably something like that would take months, if not years, to end up in the Supreme Court. And so it could kind of remove it from the front pages, remove it as an immediate issue, but then it would morph into kind of more of a constitutional crisis, but live more in the background. But that to me feels like more plausible. That could kind of take and rumble on for years.
Yeah, they could do an emergency stay. They could do something more immediate like that. But again, you'd already passed the point of no return. And so I think it'd be largely moot, and it'd go back to the politicians and become an electoral issue. And the last one is they can declare a national emergency. So like President Bush did for Katrina, like we did for September 11th. There's all sorts of instances in our history where a national emergency was declared, which gives the executive branch more power. And under that, they could spend more money and basically suspend the debt ceiling. But again, all of these are very low probability options.
So let's, with an eye on time, we're running 1 minute over. And if it's okay, we're going to keep rolling for another 2 or 3 minutes, because I think this is a really fascinating discussion. I'm learning a lot, Jake, from you. So tell us, like, what is the end game? You've talked through different probabilities, different scenarios, prioritization of payments, and how that can kind of work at the micro level. But when you step back, like, how does this thing ultimately play out?
Yeah, so it's really about the leverage that on the one side, House Majority Leader McCarthy has, because there's a very slim majority in the House. And so it's unclear how much negotiating leverage he has. Of course, it took him, an unprecedented number of votes to actually get the speakership. He's had a pretty tenuous position in the years since, but he was able to pass a budget through the House recently, and that kind of reinforced his negotiating position a bit. And obviously in the Senate, it's a very narrow majority as well. And so what we think is the most likely outcome, and I think President Biden alluded to this to some degree yesterday and earlier today, is it comes through an agreement on the budget resolution. So what the budget resolution is in Congress is it sets the aggregate spending limits for the government. And those are ultimately incorporated into an appropriations bill. So when we actually say how much we can spend in each of the 12 major areas of government, and so on the road to the fall and say, okay, we agree that the aggregate amount of spending for the federal government next year during this appropriations agreement will be X. But we can agree to disagree on what we're going to cut until the fall. And then we can fight it out. Do we cut discretionary spending? Do we cut defense spending, et cetera? And so it's basically a way to kick the can down the road. And then we get the added bonus of pairing it with a government shutdown. Because again, if the government isn't funded through the appropriations process, non-essential services shut down, the government shuts down.
Why is that an added bonus of doing it when there's a government shutdown?
Well, because then not only do you have the debt ceiling as a thing to argue about and a thing to weigh on investor sentiment, then you have the possibility of a government shutdown at the same time. So it's just another thing to become concerned about.
So then questions here like, would you expect to see federal agencies start to shut down and federal employees stop being paid in relation to defaulting on Treasury debt? I guess you kind of alluded to that, but maybe just quick thoughts there.
Yeah, I mean, I wouldn't expect so. So government paychecks wouldn't go out. But unlike the shutdown, there wouldn't be a mandate for them to cease working. So in a government shutdown, normal federal employees, non-essential workers, are told not to come to the office. They're actually told you cannot work. You know, legally, we're not allowed to have you here if you're not essential. Whereas in this case, it would be continue to work as normal. We're just not going to pay you, and we don't know when we will. So It's kind of the worst of both worlds.
Sounds like a great deal. So your base case then is this is essentially the can is gonna proverbially get kicked not too far down the road, but long enough to kind of take us out of the eye of the storm immediately. But it sounds like this is going to come back around sort of November-ish time. Is that right?
Yeah, it's unclear when they'd actually suspend the debt ceiling too, but my guess is they'd agree to a budget resolution, and then they'd suspend the debt limit until sometime in the fall. It would be reinstated. Again, they'd get extraordinary measures, and maybe that takes the actual next kind of cliff to, December, January, February. It's really uncertain about when they'd suspend it to. But they just begin the dance again. And, this is something that at this point we're doing every 2 years or so.
Okay, and last question is around risks to the de-dollarization theme or narrative. It's pretty prevalent at the moment. Is this going to add to that narrative? Is that narrative credible? Is the world going through a de-dollarization of the process? And how would this debt ceiling debacle play into that?
Yeah, I think a default would clearly play into that. I think you'd be insane not to have, be second guessing if you're a large reserve manager, holding a lot of your liquid assets in treasuries, if there's a possibility you're not going to be paid on that. So I think it would surely kind of accelerate any diversification you might be doing. But I think to the general point about whether we're seeing de-dollarization, I just don't think you can see it borne out in the statistics at this point. You're seeing some diversification in reserves. Largely that's going to gold, and largely that's through areas that have been kind of shut out of the dollar system, so most notably Russia. But if you look at the share of trade denominated in dollars, you look at overall reserve holdings in dollars, it's very hard to see any shift away from the dollar. Even though, sure, the dollar can depreciate in the near term, and for many countries that's a benefit. But I think there's just not a viable alternative to the US dollar at this point. People talk about the yuan, Chinese renminbi as the most likely inheritor of the throne or even competitor. But that currency isn't readily convertible at this point. There's not a deep and liquid securities market. There's investor, capital flow restrictions in and out of the country. And I don't know if people are willing to be tied to that political system any more than they're concerned about our own political dysfunction. So at this point, I think it's a fun and interesting topic, but it's a multi-decade story rather than anything to be concerned about in the near term.
For reasonable investment horizons. I think Bill Gross said it well a few years ago, where the US remains the cleanest shirt in a dirty neighborhood. Before we wrap up, I just thought we'd ask one more question. What do you think will be the best performing asset class over the next 12 months. There's a lot of options here. S&P 500, US small caps, international equities, commodities, high yield, or cash. Please answer now. That's S&P 500, US small caps, international equities, commodities, high yield, or cash. We'll wait for some of the answers to start coming in there. Just give that a second longer. And as we're waiting for people, Jake, any final thoughts that you want to finish on today with everything that we've kind of gone through?
No, I think we've covered it all. I mean, the important thing again is that there's a lot more noise than signal in this process. So it's important to just stay focused on your medium and long-term goals.
Interesting. So out of the participants, just over a third think international is going to be the best performing, and it's obviously started pretty strongly this year relative to the US and last year as well. It'll be interesting to see if that continues and commodities there in the minority. Well, if you have any questions, look, thank you so much for your time today. I know your time is valuable. I hope you all found that informative. Jake, thank you for sharing some real insider's insight there into the inner dynamics of the Fed and the Treasury and how this works and how everything's prioritized. I hope you found that all informative. If you have any follow-up questions, please don't hesitate to get in touch. We've got the contact details on screen for you there. If you did ask a question and we didn't get a chance to answering it, we will try and turn around answers and get back to you directly as soon as possible. And with that, thank you all very much.